Okay, good evening, everybody. Let's go ahead and get started. Let me know if you guys can hear my audio and see my screen in the chat box. Just give me a little Y or yes there, just to let me know that it is indeed working. Hope everybody's having a fantastic evening so far. I'm looking forward to going over the COT report with you guys tonight. This is my favorite class of the week. So I really love going over this webinar and just the discussion. And I feel like we always learn something new going through this. So I'm excited. Just want to welcome everybody here. Also want to give a shout out to everybody in the recording. Want to say hello to you guys, whether you're watching this on YouTube or whether you're watching this on the calendar. Just want to welcome you here as well. Feel free to ask any questions throughout the webinar in the chat box function. I should be able to get to those as we go along. And if you are watching this in the recording, feel free to ask those questions in the comment section down below. All right, guys, well, let's go ahead and go over our disclaimer before we jump into the discussion today. As always, I need to remind you guys about the risks involved in this market. You can lose all or more than your initial investment if you're not careful. So please be aware of how many pips you're risking on each trade, in addition to how big your lot size is, and ultimately how that would affect your account if you were to lose money. So make sure that you're going through that process each and every time that you take a trade. All right, guys, so let's do this. Look at the COT report statistics for the week. And then let's see, let's actually go over here. There it is. Okay. So as of this morning, in fact, I can pull up my statistics here and see if anything's changed. But as of this morning, we were down. It's been a little bit of a rough week. We're down 327 pips for the week from the top 6 trades. The only real trade that's coming clutch is the USD yen trade. And let's actually update that real quick and just kind of see where everything's at. July, as you guys know, is not typically our best month for the COT report. It just isn't. And there's not much else to it other than you just keep doing what you're supposed to do, and then you will lose some money in the process, just depending on how things go in July, which historically July, I don't know why, just not the greatest month. But let's go ahead and update this real quick. So on the dollar yen, this one's up 74 pips right now. The USD CAD, that one's down 69, and then USD franc down 42. Pound yen, I'm down 95. Okay, and then the rest of these those two are closed. So the pound CAD, pound franc, those are closed. So right now we're sitting at minus 319 on the week. It's very similar to last week. One of the things that I wanted to show you guys, I did briefly show you this morning in the live trading, is these statistics over here, just showing you the average over time. So over time, you should expect the COT report to make you about a 200 pip gain a week. Right now, it's a little bit below its historical average just because July has been a little bit of a downer. So typically about 200 pips a week is what you're supposed to make. Right now, it's averaging about 187, 188 pips a week. I showed you guys this last webinar. If you cherry pick March 21st to June 27th, that was a pretty good period. It was averaging 278.6 pips a week, so about 100 pips more than what you're typically averaging. In June to July, this is also kind of cool. So despite having a bad July, if you take the June and July COT report, all the weeks in June and July, you would be up 1,190 pips. Not bad, right? Now, this is where it gets interesting. So the average in June and July is still 170 pips, which is a little bit below the average, but it's still a stout 170 pips a week. Now, this is where it gets really interesting. June is averaged 466.5 pips a week. So if you take the 4 weeks we traded in June, 466.5 pips is what you would have made in June every week. So that's the average, because there were several winning weeks there in June. There was one week in particular that was really, really good, but there were also other weeks that were also generally pretty good in June. So I think there was only one losing week in June. Let me double check. I think June just had one losing week, or none, actually. No, it just made money. So it just made money in June. The worst week, the worst winning week in June only made 74 pips, but everything else was profitable. Here's that 202 right here. That's pretty much your average. A plus 1286 here, a plus 74, and a plus 304. And that's how you're able to get that average of 466.5. Now, this is interesting. Now, July's average is negative. So not only, so we came off of a pretty good June, right? We'll take it. July was minus 225 pips. So that's what we're at so far. That's what we're averaging. And that's obviously not good. You want to be profitable. You want to be above that. And we will. In June, we did talk about this. If you go back and look at the COT report webinars from June, we did say, you know, hey, look, guys, these are great weeks. We're doing well. People were passing challenges. Things were really good. But I just said, you know, hey, guys, this isn't going to last forever. It's going to return to that average. And here we are. So we're averaging out. We're smoothing out. You know, if you just take the average of June and July, yep, you're averaging that. Real quick, I was just curious. I wanted to see, what would May's average be real quick? I just wanted to see what that would look like. Let me just do an equals average. I'm just curious. Equals average of May. You're looking at starting here. Let's grab these next 4 weeks right there. And let's come over here. So May was a little bit below the average, but it was still profitable. So this is May's average right here. Still good, right? Still good though. And so, you know, in May, it's probably like, you know, if you're in May, you made some money, you might be thinking, well, it was good, but it's still below. So you might be thinking, well, we might have more income coming soon. And that's exactly what happened in June. You know, June was so amazing that July has now kind of fallen backwards a little bit. We still have some more time to trade July, right? We still have the rest of this week and we have next week. You know, maybe next week helps smooth that out and maybe fixes that average out. Perhaps positive, maybe closer to a break even July. That's kind of what I'd be hoping for. So we'll definitely see. You know, I can't tell you for sure if next week's going to be a winning week or not. We really just, the only thing we can really do is just continue to trade the strategy. I can't really do anything else besides that. But what I'd like to do, you know, I've had several people ask me, especially those that are kind of newer to the program. A lot of people have asked me, hey, Steve, why don't you do a webinar where you kind of explain the details behind how I'm selecting these top trades of the week. I could see how that could be kind of confusing. So let's kind of start from square one with the COT report, kind of how it came about, why we trade it, the fundamentals behind it, just everything you'd want to know about the COT report. So The COT report, for those that are new, COT stands for Commitment of Traders, okay? And it's a report that's released by the CFTC.gov website. So if you go to CFTC.gov right here, this is a regulator in the United States. These guys manage and regulate the commodities and futures markets. And one of their responsibilities is to release this COT report every week. So commitment of traders. And it tells us how many positions outstanding are held by the banks on different currencies, on different stocks, and on different commodities, obviously the futures market. And this is very helpful information when we're trying to figure out what trades to take, because in general, a lot of these banks are really good at trading and they make money over time. Do they make money every week? Not necessarily. Do they make money every single day? Again, I would say not necessarily. The banks do carry drawdowns. I mean, do you guys remember back in, I mean, we're still going through it. We had that bank crisis that was kind of scary. Maybe it's still ongoing. We just haven't heard much about it. But it was in the news quite a bit. Was it May or April? What months were those when we had those big banking crises with Silicon Valley Bank and Signature Bank and a few others? And I actually have some relationships to a few other banks. I probably am not going to name them here in this webinar. It would not be appropriate, but I do know of some other banks that are regional that are still struggling and are refusing to pay out certain investors. I literally know an investor right now who's had that problem, owns a very large portion of a regional bank and cannot take a withdrawal right now. So again, it's still an ongoing issue. So what I'm trying to say is banks still have drawdowns on their trades, even though they're successful. So one of the big trades that these banks have right now is they've purchased a lot of bonds. A couple of years ago, they had a surplus of cash because of all the stimulus checks, the PPP loans. The economy had a major injection of liquidity. And we had this huge liquidity event, and the banks were like, okay, we have all this money. What do we do with it? And we have no other loans to write out. We've given out all the loans we could possibly give out. So what banks do is when they have too much money, they go out and buy US treasuries, okay? Because that's a form of debt that can pay them a dividend over a period of time. The problem is they bought way too many of these at high prices and very low interest rates. Now, since rates have gone up, rates are now more favorable if you're a bond buyer, but the subsequent prices for those bonds have come down. So these banks are actually in a drawdown, and that's exactly what happened to Silicon Valley Bank. Is they were in such a big drawdown that they didn't have the ability to pay out they had a lot of deposits come in, and people saw that withdrawal requests come in, and they didn't actually have enough money to pay out those withdrawals. So they defaulted to selling off those bonds at lower prices that they had purchased 2 years ago. So they were down on this trade. They were forced to liquidate a trade that they were down on billions of dollars. And that's what caused the bank to fall in 3 days, right? So anyway, what I'm trying to say is these are longer term trades. A lot of times as traders, we want to make money every single day, which is why we trade other things like price action. We look for smart money concepts, and we trade those things to try to find ways to create income daily. But even those things don't always create income daily or even weekly. So for me, I'm okay if the banks take me kind of on a roller coaster ride, as long as overall the banks are going to carry me through and I'm going to get a really big win in the end, right? So that's how my thought process, that's my perspective. And when I'm looking at my payout in the future, I don't look at my payout as, am I going to get paid this week? Sometimes I don't even look at it as a monthly occurrence. For me, when I want to get paid, I'm looking at this like, okay, in 3 months, I want to be funded. In 4 months, I want to be funded. Can that happen? Most likely, very much most likely. Could it happen in a week? Probably not, unless you hit one of those good weeks like we had in June. There was one in April. We had a couple that were back in January and February. If you start your challenge and you're fortunate to start your challenge on one of those weeks, yeah, you're probably going to pass in like a week or two. But if you're like me, where I just started another challenge, that challenge is currently down. it's probably not going to pass in a week or 2 weeks. It's probably going to take the normal 3 to 4 months to pass, right? And that's how I view my payouts, and that's how I view the COT report, is this longer term investment. Like, I'm going with the banks on this. They're going to raid for a month, reverse for a few weeks, go on another raid, reverse for a few weeks. And during that reversal time, you might lose a little bit of money because they're taking profits. Right. Anyway, so that's kind of my perspective with the COT report. So when we look at this information, here's the COT report right here. This is the one I use. It's called the Current Traders and Financial Futures Report. It's this one. So again, how did I find this? You go to Market Data Economic Analysis, go to Commitment of Traders, takes you to this page. I scroll down to the long format of the financial report. I click on it and it takes me here, right? And this is the report. It'll always be dated a Tuesday. So the last one was July 11th. Basically, what these banks do is they publish their information and the current holdings they have in the market to the CFTC every Tuesday. And then on Tuesday, the CFT receives this information. They take a few more days to compile it. And then by Friday at 4 p.m. Eastern, they then release this information to the public. And at which point you, me, and everyone else hops in here. Seriously, millions of people, at least hundreds of thousands of people, jump into this report on Friday or Saturday. And I know of a ton of people that have their own journals and their own methods. I actually know several friends of mine who are really good traders who own their own companies that use the COT report as a tool, a proprietary tool, which is actually pretty cool. The closest thing I have to that is the journal, which is what you guys already have access to that journal, which we'll go jump into in just a second. But this is what the COT report looks like. And in a nutshell, you have different participants. You have the dealer side of the market, you have the asset manager side, you have the leveraged fund side of the market, okay? And this is in the futures report, the financial futures report. There's other reports like I mentioned earlier, but this is the one that we focus on. The dealer side, these are market makers, and these are people like brokers who go out and buy and sell instruments, currencies, with the primary purpose of having them available to their clients. So they're not really speculating in the market. They're just trying to have contracts available. That's kind of generally in a nutshell what dealers do. Asset managers, these are folks who are hedge funds, and they're often using the futures market or Forex market for the purpose of simply offsetting other assets that they have when they're managing pension funds, 401ks, IRAs, things like that. That's what these guys are doing. So they're probably not the best people to follow, generally speaking, because they're not in it to create some massive income through the futures market. It's just to offset other instruments. Now, on the other hand, you have leveraged funds. Now, leveraged funds, if you read about this, which I'll show you where to go read about it, leveraged funds, these are participants in the market who are taking outright positions, and the positions they're taking are designed to simply make money, right? When they manage funds, they're just out there to make money. There's no other purpose other than that. They're not trying to hedge. They're not trying to become a market maker or a broker. They work for some company or agency or firm with the entire purpose of just being right and making as much money as possible, right? So these guys are pretty good, and I would say they're most aligned with our goals, because what's your goal in the market? My goal in the market is very similar to all of yours, if not the same, which is to make money, right? We wouldn't be here today unless we were trying to improve our lives and increase the amount of money that we have in our bank accounts so that we can go out and do the things that we want. If your goal is to buy a new car, or your goal is to be able to afford, just have more time and freedom, or if it's to donate to your church or charity organization or whatever it is. We have a lot of goals. Every single one of us does. And so that is often the same goal of these guys, right? And they have all their things that they want to do. And the only way they're going to do that is if they make money, right? So I like to follow these guys because in general, they're going to be right. Now, they're not always right, right? As you guys know, this week, it's been a little bit rough. But in general, if you follow what these guys are doing, there is a specific method to prosperity. There's a specific method to, at least we've created a specific method to follow what they're doing to get there, right? So that's why I really like to follow leveraged funds. So let's, so when I come in here every weekend, what I do is I look at the long positions and I look at the short positions. Okay, so what this tells me is, for example, on this first currency is on the Canadian dollar, currently in the futures market, the leveraged fund side has this many long positions and this many shorts. So you can see that there are more shorts than longs. And when I see that, that tells me, maybe we should consider a short position, right? Right. So we're just trying to think what they're doing. The other thing I like to look at is the total change. So the change in positions from week to week. So you can see they have dropped their short positions significantly from the previous week, but they've also dropped in their long positions significantly, right? So again, when I see these numbers dropping together, that doesn't matter as much. What really matters is if you see one going positive and the other one going negative, that means there's some kind of conviction in the market to send the market a certain direction, okay? So that's what I'm looking at. Now you can search through here. So if you just do a Control F and search whatever currency pair you want, like the British pound, just search GBP, and that's going to pull up the British pound. And it'll take you right to it because there's a big long report and you want to be able to navigate exactly where you need to go because you could get lost in this report. So I just do a Control F and it takes me exactly where I want to go. And I'm just looking at specifically, again, leveraged funds. And I want to see how many longs they have this week, how many shorts they have this week. What are they doing? Are they adding longs? Are they adding shorts? It does look like they've added a few more shorts than longs this week. That could have actually helped us a little bit, but at the same time, you know, for me, I really do care more about, at least in the strategy that I trade, I care a lot about which direction they currently, where are they putting their money? You know, if their money's here, then that's where I want to put my money. If their money's here, then I'll put my money over there. But so far they've, up to this point, last several weeks, the British pound has been this direction, right? It's been on the long side. Okay. All right. Once I gather this information, I then take it over to my COT report journal, which is right here. A lot of you guys have seen this before. If not, that's fine. I'll introduce it to you. Here is the link for those that want it. If you cannot get into this, just send a request to get access and I will grant you access and I'll make sure. I just have to verify that you are indeed a member of the program to give you access to this. So basically, so long as you stay a member, you'll have access to the COT report. If you ever leave the program, the access would be taken away. But the other reason why I do this is because I actually used to give this out for free. It was so valuable that I was like, nah, this is definitely for the members. So if you, again, for being a member of the program, this is something that you get access to. And you can come in here anytime and take a look at the statistics. You can look at just anything you want to look at in here, which is super awesome. So when I fill out this report, I'm filling out the long side, I'm filling out the short side, as you guys already know. I'm also putting in the long change and the short change right here. And then all these other numbers you see are just derivatives of whatever I inserted into those 4 columns. Okay. So first, let's talk about these 2 columns right here. These 2 columns are probably the most important because it's columns E and F, because they tell us what percent is long and what percent is short. So you'll notice, for example, on the euro, there's a lot more people who have positions on the euro than, say, the franc. So you can see there's 130,000 positions outstanding on the euro versus only 15,000 outstanding on the franc. But does that mean we shouldn't trade the franc because there's only 15,000 outstanding? No, we just need to make sure that we know what percentage of the positions on the franc are outstanding versus the percentage on the euro and so forth, right? So when I look at this, I want to find out what percentage of all the positions on the franc, for example, are long and what percentage are short. And again, when I'm looking at the euro or the pound or the kiwi, it doesn't matter. I want to know what's the percent long and what's the percent short. Now, this is where the fun part comes in. when we're trading the COT report strategy, the version of there's a lot of different ways to trade it, but the version that I trade, I want to look at what is the most long currencies, the most bought up currencies at the moment, as far as current holdings go. And I want to look at the most shorted currencies. And again, that's as far as current holdings go. So for example, this week, the top currency pair to trade was the dollar yen. That was the most bought currency. As you can see, the dollar is actually somewhat bought right now by these banks. And the yen is still the king of shorts. So it's a very weak currency. The reason why we want to pick two is because when we trade in Forex, we trade in pairs, right? So I can't just go buy the dollar. I need to buy the dollar against something else. I can't just go sell the yen. I have to sell the yen against, I have to pin it against something, right? So I want to pick dollar against yen that's a good example. That's actually a trade we would want to take. I often compare this to a sports analogy. You guys are probably tired of it now, so I'll just go quick. So basically, you're just trying to find the top team of the week versus the worst team of the week. So, you know, if you're familiar with sports betting, you're just trying to find who's the best team versus the worst team, and you're betting on the best team to win. Again, are you always going to win? Even though you're betting on the best team and betting that the worst team loses? No, not always, but there's a good chance that over time you would be right. Okay. There's a good chance over time you would be right. So that's what we're doing. So another good option would be to pin the dollar against maybe the CAD or pin the dollar against the franc. The pound this week was strong, so we pinned the pound against the CAD, franc, and yen. And that's how we're able to get our top 6 of the week. You could pick the top 3 long positions as well. Like I could have gone with, you know, let's see, the Aussie perhaps. My only qualm with that is then that would have given us a lot more trades. And I'm only interested in just trading 6 of the best trades. Typically, if you can just trade the top 6, that's all you really need. Okay, so I'm just trying to find the top 6 trades. That's it, right? And so in order to get 6 trades, I need a combination of 3 shorts or 2 longs, or 3 longs or 2 shorts. Okay, that's how I'm able to get that combination every week. So you look at this week, I had 2 longs and 3 shorts. The week before, I had right here 3 long options and 2 short options. Once I have 2 and 3 or 3 and 2, then I can create a combination of 6 pairs. That's how I can do that. Okay. And again, I don't feel like I need to go out and venture and get more. I'm perfectly content just trading the top 6. Okay. Let's see. What else? Any questions about how I'm able to find what to trade through the week? So basically the routine is on the weekend, Saturday, I go to that report, I plug in columns C and D and also columns H and I, and then all of this fills out for me. Then the next step is to find out the longs and the shorts. And then I go over here and create 6 currency pairs for the week. Now, that's half the job. The other half is managing risk. So we got to figure out how big of a stop loss do we need to have? How big of a lot size we need to have? How big does our take profit need to be? So quick thing for those that don't know this, when we're trading the COT report, we actually don't use a take profit, which for a lot of people sounds crazy. Like, why don't you use a take profit? Well, the thing is, guys, we don't know how far the banks want to take this. Sometimes, as you guys know, who have traded this a while, some weeks the banks just go, 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 and they really take the market a specific direction. And when they're doing that, we want to make sure that we capture as much out of the market as we could possibly capture. Okay. And so when you don't use a take profit, you can get some very substantial gains, and you're going to need those gains because those are the gains that make the whole difference, right? If you're cutting your trades early and taking profits early, that could come back to hurt you as a trader. I've seen it happen a lot. Some traders have been lucky, and I really do mean this. It's just lucky when you close out certain profitable trades early, and maybe by the end of the week, your trades would have gone down a little bit. So you're glad you took those profits early. But by and large, it pays to hold and to be patient and to have diligence and wait until Friday. So what we do is we take the trades on Sunday night or Monday morning, just depends on where you live in the world. Basically, as soon as the Tokyo market opens up, first couple of hours of Tokyo, at the start of the week, that's when you want to have your trades in and you want to hold the trades throughout the entire week. Then what we do is we make sure that we always have a stop loss and that we're always using a trailing stop. You don't have to use a trailing stop, but I do recommend it highly, very much highly recommend it, because you want to protect your capital if there's a way to protect it. If the market does go in your favor, and if midweek the market decides to go against you, you want to protect your capital, right? So, so that's why I like to use a trailing stop. And then the last thing that you need to do is make sure that you use a lot size calculator, because it does vary how big your stop loss is going to be per trade. Some currency pairs require a much bigger stop loss than others because their ADRs are way bigger. And some ADRs are much smaller. ADR stands for average daily range. So, for example, the pound yen, which is known as GJ, has the biggest average daily range in the entire Forex market. Okay. If you've been trading Forex for a while, pull up a chart, or if you haven't, pull up a chart on the pound yen and just measure how many pips the market moves every day. It's an absurd amount. Even on the days where it doesn't move a lot, it's still a lot of pips. Okay. So it's got a very big average daily range. Now, also in the Forex market, does anybody know what the lowest ADR currency pair is? I think I said it last week. I'm just curious if anybody remembers. What's the lowest ADR? Yeah, I'm gonna pull this up actually on Maytaf. Anybody want to take a guess? Well, before I answer the question, I'm just curious if anybody remembers. It's okay if you don't. I was just curious if anybody remembers it. So it is the Euro franc. So this has the lowest ADR in the market. And this can change over time, but as of right now, it's the Euro franc. And this goes for major currencies. So there's 28 major currency pairs in Forex. And the Euro franc has the lowest ADR. And yeah, if you find like right here, yeah, on Tuesdays, it's lowest low to its highest high is 39.7 pips. So it's pretty dang low. Now, in comparison, let's pull up GJ, pound yen, right? If you pull up GJ, the average daily range on the pound yen, look at this, guys. So on its lowest days, 119.9 pips. On Fridays, it's 160.3. So pretty big difference, right? You're looking at one who had like 38 pips, and then this one's 160. So if you want to do the math on this, 160 divided by, I think it was like 38, it's 4.21. So what that means is the pound yen, GJ, moves 4.2 times more per day, whether that's up or whether that's down, than the Euro franc moves, right? This is a concept that a lot of people don't talk about, and not just in my strategy, the COT report. So, and I don't mean to say my strategy, guys. This is our strategy. I want to make that abundantly clear that this is our group. We're working together. I want you guys to feel like, I want you guys to know that we're a team. And so when we lose together. When we win together. When we get funded, we fund together, right? Like that. I want that kind of group. And so, I don't want this to be like me versus you guys. We're definitely a team, so we take the same trades together. So we weather the good, we weather the bad together. That's our group, right? So in our strategy, the COT report strategy, obviously we're taking really good notes on how far currencies move throughout the week. But like I said, a lot of other groups out there don't look at currency pairs and the parities between the two. Sometimes people just think, oh, I'm just going to use the same lot size when I'm on the euro franc, and I'm going to use the same lot size if I'm on the pound yen. It doesn't matter. And I'm here to tell you that it does matter, right? And I'm showing you why it matters right now, that you make sure that you tone each currency pair to its natural state, to its environment that it naturally plays in, right? I hope that makes sense. It makes a lot of sense to me, especially now, because if you think about it, if you're just going to use when I was a beginning trader 10 years ago, when I would trade the pound yen or the euro franc or the euro dollar or whatever, I would use the same stop loss and the same lot size for everything I traded. It was just a default, 20 pip stop loss on every trade. And, it's over time, you're just not localizing your efforts, and you're not serving that currency pair best or your strategy best unless you're toning everything to the currency pair or the environment that you're trading in. So that's where this concept comes in. So one of the things that we do to manage risk every week, and I think we manage risk really well. I know it stinks when we lose, but guys, I am in love with the way we manage risk. I think we do a phenomenal job at cutting our losses. We're very strict at making sure that if you're going to lose, you lose exactly where we're going to lose at, and we don't deviate. We definitely get out of bad trades when they are bad. We give them room within the playground and the environment that the market's working in, but we don't go beyond that. So, for example, what we do every week is we look at, okay, on the pound yen, for example, if we're going to trade this, we take the biggest average daily range of the week, which appears to be a Friday. Yeah, you can just kind of go through here and you can see the different days of the week. Looks like Friday's the biggest day at 160 pips, right? So that's going to be my stop loss for the week on the pound yen. And that's a week-long stop loss. So like I said, I'm not sure why it keeps doing this. Okay, that's fine. But it's a big stop loss. Yes, it is a big stop loss. But guys, think about it. It's a 5-day long trade, right? It's a week-long trade. We've had trades that have made over 500 pips. I mean, we had a trade in June that made 490 pips. At one point, it was up over 500, but we ended up closing for 490 on the euro yen. Okay, so if you're going to make 490 pips in a week, you need to have a stop loss that's bigger than 10 pips, bigger than 20 pips to accommodate that kind of market volatility, right? If on an average day, the market moves 160 pips in a day, then that means that a 20 pip stop loss by and large is not going to cut it. You're going to need something much bigger. Now, you could argue that 160 pips is too much. Yeah, you could try using a half an average daily range. I've had some poor results doing that, just so you know I have back tested that and I have tried that. Yeah, maybe I will exit those pages. I'm not sure why that's doing that. So I have back tested using a half an average daily range as my risk management model instead. So instead of using 160 on GJ, I would do 80 pips instead. And I've noticed over time that if you do that, you tend to lose out on a lot of really good trades. And you're often out of your trades way before Friday doing that. If the market moves at all against you, often you're just out of the trades and there's nothing to trade until Friday. This week's been a losing week, but so far, and we still have, I believe, 4 trades active. It just depends on when you got in on Sunday night or Monday morning. You have 3 to 4 trades still active at the moment. Yeah, I still have 4 trades. Last I checked, I still had 4 trades going. But yeah, so that's what I do, is a full average daily range. And then when I go into MT4, I use a half an average daily range trailing stop. And the reason why we do that is because the way the MT4 trailing stops work is they don't engage, they don't start trailing the market until the market's moved the specified amount that you determined at the beginning of taking the trade, which is a half an average daily range. So for example, with the pound yen, if you use an 80 pip trailing stop, which would be half the average daily range, the market would have to go in your favor 80 pips before that trailing stop would go to break even. So it's not even going to be, it's going to act like it's not even there at all until the market moves 80 pips in your favor, right? So I've actually been working with Mark on this. He found a dynamic EA for MT4. I'm going to test it out on a demo for a week or two, just to make sure I've got all the bugs kinked out on it and everything looks good. If we can do it well, I'll probably do a demo video just showing everybody how to set that up, because I think a dynamic trailing stop would be better than the current MT4 archaic way of using a trailing stop. So yeah, the dynamic is great. And the reason why dynamic is great is because it's how a trailing stop should be used, in my opinion, anyways, because the whole idea with trailing stop is the moment the market moves even a pip in your favor, you want the trailing stop to move up a pip as well. So it's just moving up in your favor as the market moves in your favor, and you're cutting that risk down pretty much immediately. That way, if the market does pull back against you and you lose money, at least you cut a lot of that risk down pretty early in the game, right? Dynamic is the way to go if you can, in my opinion. So we're going to, try to get that going. I want to make sure that we get it done right. So that's why I'm going to test it. But yeah, dynamic trailing stop would be preferred. But since we don't have that capability at the moment, we're just going to do the traditional, here's your half an average daily range trailing stop with your full average daily range hard stop. Okay. A hard stop is just simply, if the market loses, you hard stop out at a specific level and you're done. You're just out of that trade, right? So, okay. So let's kind of, I've demoed this before, which, by the way, last week I made a video of me taking the trades for the week. So this was just a video where I went out, took the trades on Sunday night, and I recorded myself taking those trades from start to finish. So if you're having troubles trying to take the COT report trades because you're on your own, because I don't host any webinars on Sunday night. I know some of you, some of you are in Malaysia or Australia, New Zealand, some of you are in England. It's actually terrible timing if you live in England, because you'd have to wake up in the middle of your night, basically, to take these. Unless, well, you could, I mean, I guess it'd be, if you lived in London, for those of you in Europe and Africa, you could take your trades. Let's see, you would have to take yours. Let's see, you're ahead of us. So maybe just right as Sydney opens. So, maybe spreads are not as good, but just as soon as Sydney opens, you do it, because that's your bedtime. So you'd have to go to bed, take those trades, and that would be the very last thing you do before you go to bed. Yeah, but you'd have to do it earlier than we do it, because I take my trades usually between 8 and 10 p.m. Mountain, which is between 10 p.m. and 12 a.m. Eastern. So yeah, if you lived in England, you'd probably have to do that just earlier, like 4 or 5 hours earlier than I do it. Anyway, if you live in Australia, that's kind of where the day starts. And that's kind of where the financial week starts, is, Tokyo, Sydney. So your markets are the first to open. So you guys kind of have that luxury to just get up on Monday morning and just take those trades pretty much immediately. And so you would want to just make sure that before you go into work on your Monday morning, you just take those trades and you'll be good. For us here in the United States, we just take them our Sunday night, and that works. So, cool. Mark says works well after a week of testing. Yeah, the trailing stop, that's good. Yeah, I need to go set it up and just get it done, because I want to make sure we can use a dynamic, because even this week, there was a point with, I know the pound CAD's closed out. There was a point, in fact, let's go take a look at it, where it was profitable. Oh, these guys, let me see these. Oh, it's okay, guys. Do you guys remember this morning we marked these up. I just got alerted that these just broke above our alerts. Okay, this is cool. We might find an opportunity here on the NZD franc and the, was it the NZD yen? Yeah, the guys, there could be some opportunities here. That's pretty cool, actually. Okay. So yeah, obviously dynamic would be greatly, wouldn't it? Yep. So let's see what else was I going to say about that specifically. There's something I was going to say. I went over here. Why did I come to TradingView? Because I wanted to show you guys, oh, the pound CAD, for example. Yeah, that's what it was. Okay. Cool. There's some price action trades loading up as I just showed you guys there. That's kind of cool. Might be have an opportunity there. So with the pound CAD, the start of the week was right here. Actually, it doesn't look like you would have had a great opportunity. Like that's the start of the week. I mean, it was up maybe what at one point like 18 pips, and then it was down, and it came up again, and then it was down. There could have been a little bit of an opportunity to save you on some of your pips, but you were still going to lose on the pound CAD. Like all of us, even if you had a dynamic trailing stop, you still lost money on the pound CAD this week. The thing about it though is with the dynamic, you could have lost a little bit less. Like even if you lost, I don't know, 10, 20% less on that trade, that's still, you still save some money, right? And I think as much money as we can save on the losing weeks, the better. Because again, I don't know how to avoid the losing weeks. Unless I can find a way to do it, I don't know how to do it. I just don't know. So what I can do, and this is why a dynamic, in my opinion, would be so much better, is if we can limit what we lose, that's the best thing we can do, because that's the only thing we can control. And then when we win, we're already doing a really good job with that, by the way. When we win, we're just letting the trades continue to go, and the trailing stop's just behind it the whole way as it just continues in your favor. So that we're doing a really good job on. I do think there could be something said about limiting how much we lose on the losing weeks, right? So for example, this week, down 300 pips, last week down 300, we were going to lose no matter what. So if we could have limited those losses to like 150 pip losses to 200 pip losses, that would have been so much better. And so that's where I'm on that's my big quest right now, is how can I limit that? And it may just require tightening up the stop loss a little bit, but I'm a little bit antsy about just tightening up the stop loss for the purpose of tightening up the stop loss. So it's just something I'm thinking about. Okay. Okay. So anyway, I just wanted to come check that out real quick. As you guys know, after you go and get your average daily range over here with Maytaf, which you don't have to do this, by the way, for those of you that are new to the program, you guys can actually right here on the Telegram channel, you guys can actually just go and get the signals from me on the weekend right here. I'm going to post the top 6 trades, and I'm also going to give you the corresponding stop loss and take profit, not take profit, just stop loss for the trade. So all you have to do when you're taking these trades is you just have to go on the weekends, before the market opens, is you just got to go through the lot size calculator process. You just go to my FX book or wherever you like to go, and you're just going to plug in the pair that you're trading. So if you're trading the dollar yen, like we did this week, let's pull that up. You just put in dollar yen. You change the account currency to the account that you're trading in. So, if you live in the United States, that'll stay US dollar. If you live in Australia, probably AUD for Aussie. And then if you live in England, you'll probably change that to pound or whatever you're trading in, right? So just your home currency is what goes there. Okay. Your account currency. Then you put in your account size. So for me, typically that's a $200,000 account. And then I just do 0.75 risk per trade. For those of you that don't know, the reason why I do a 0.75% risk per trade is because I'm taking 6 trades. So 6 times 0.75 equates to a 4.5% risk. So if all my trades lost, for example, all at once in the week, I could lose up to 4.5% of my account in a week. For me, that's an acceptable amount of risk. If 4.5% is too much for you, then definitely lower your lot size to something more suitable. So if you do a 0.5% risk, that's 3% risk per week. In my opinion, that's too conservative. For me, that may be perfect for you. I just don't know. You could do, I on my personal account, I do 1% risk. I actually have another account, another personal account where I do 1.25% risk per trade. That account is down on the losing weeks pretty bad, but on the winning weeks, it's just glorious. Oh my gosh, like last month in June, that account made like 25%. This month, I think it's down like 8%. It's down, you know, a significant amount this month. But I made 25% in June. I'm down 8 in July. Okay, I'm not too worried about that. That's okay, right? What did you normally do before? So I did 1%. Or you're talking to Mark. Okay, I see. Yeah. Yeah, 0.75 is what most of us are doing on prop firm accounts. If you want to be super safe and really take the really safe route to funding, you'll want to do the 0.5% risk per trade. I think I don't know if you have to do that. Again, I have to be careful on this topic because I'm not actually allowed to tell you what to trade. I'm just telling you what I do. So I think conservative would be a 0.5%. You're being mild to aggressive with 0.75. You're being extremely aggressive at 1%. The reason why you're being extremely aggressive at 1% is because that's a 6% risk on the week. If you risk 1% on the week and you happen to lose the entire basket of trades, you know, you got 6 trades a week and you lose the whole basket, that's 6%. A lot of prop firms would kick you out, especially if you lost all of that in a single day. To me, it's just too much. It's just too much risk, right? Now, hopefully you don't lose that much. Like, so for example, this week, trying to figure out what percent I'm down. In fact, I could tell you guys what percent we're down on the week. I've got it right here, actually. As far as a percentage goes, I'm down 2.72% on the week. Okay, so 2.72 on the week. So as a trader, sometimes that feels like a really bad week, like minus 2.72. But guys, when you look at it, it's like, okay, so this is not been a good week. It's like the worst week since May, and I'm down 2.72%. Okay, that's not too bad, right? It doesn't seem like a huge deal at that point. Especially when you have other weeks that make quite a bit more. You know, here's a week you lost 1.72 last week before that, minus 1 or plus 1.79, plus 1.19 here, a plus 1.16 here, a plus 3.95 here, right? So there are some positives to that. Let's see. Lee says I'm doing 0.5% risk mainly because it's summertime, so I wanted to be able to lose up to 4 weeks in a row without breaching my challenge. That's actually really, really smart. Everybody should be more like Lee. That's actually pretty awesome. Yeah, it's like during the summertime, sometimes we just put our hands out and, you know, we get slapped, right? And that's just kind of just been the nature of the beast during the summer months. And there's really not much we can do about it other than just respond. How do we respond? We go through the motions correctly. We use the lot size calculator, manage our risk, stop out when we need to. We do not re-enter the trade if it loses. Also, have you guys seen that work out really well? Like, if you don't re-enter the trade, there's a really good chance that you would lose more money if you re-entered the trade. That's why I'm saying typically when the COT report works, it really works. So that's why you don't want to close your trades early. If it's not going to work, it's really not going to work. Let's see. Is there a way to view past weekly COT reports from the CFT site or only the current week? Yes, there is. That's a great question, Wes. So when you go over here to here, I'll show you how to do it. So when you're on there, homepage, you just go to the regular CFTC.gov commitment of traders report right here, their page. Then you scroll down where it says commitment of traders right here on the left side. It says historical viewable right here. You click on this, and here's all of the dates. So you can grab this one from last week or 2 weeks ago. Here's all of June's. Here's May's. Here's April, March. All of it's here. You can go back all the way to 2005, guys. Pretty cool. COT report's actually been around longer than that. It's actually been around since the 80s or 70s, I believe. But in the way that we have it today, it's only been around since 2005. In fact, if you go look at the reports from 2005, they actually look kind of funny. For example, if you click on, I don't know, just this one from 2005, this is it. So you can see the Chicago Mercantile Exchange short form. Yeah, no, it's actually, it's about what it was. You know, you got non-commercial side, which is basically equivalent to leveraged funds. Non-commercial is the same as leveraged funds, largely. Yeah. And then when you go back over here, they don't actually have a financial futures report. No, let's see, New York Mercantile, Chicago. Nope, that's it. So interesting. Cool. Okay, guys. So that's anyway. So back to how I started the webinar. The way I look at the COT report and the subsequent results of the COT report is I look at it on a holistic viewpoint. I look at it from a longer term perspective. I'm looking to make investments over time. The banks go on these raids, as you guys know. They have months where it is just amazing. When they go on a raid, we are just right, and we are right, and we are right over and over and over again, and we are really right. So that's why you got to let the trades ride. That's why we designed the trade not to have it take profit, because you're going to really capture all that move. Okay. When we're wrong, we're really wrong. Okay. As you guys know. And so when we're really wrong, we have to get out of the trade. That's really all there is to it. And then you just kind of keep doing this over and over and over again. Real quick thing I wanted to show you guys, actually, if I can show you just for one moment, let's actually go over to, yeah, we got some time here, just real quick. I'm going to be presenting this tomorrow, by the way. So you guys know I'm doing the copy trader release tomorrow. There should be a lot of people that show up to that. You guys obviously are certainly welcome to come. You will be my VIPs there. But yeah, I'm not sure how many people to expect. I've had, I think, 50 people RSVP to that. So, and I've invited like 2,000 people to come. So I don't know how many people will actually be there. So we will see. Okay, so I wanted to show you guys this. So, and I need to update this unless I have it completely updated. No, I'm updating this right now as I speak. So this is as of May. So the strategy has made almost 20,000 pips in 2.5 years. Okay. Now, as you guys know, it has periods of time where it does not do very well. In fact, it plateaus to some extent. Right here, it plateaued in last summer. And if you highlight it, this is what it looks like. So, yeah, if you just look at the COT report right here, on the left side, this is the same zone as this area in the summer of last year. So it was definitely down. The attitude and the feelings during that time are not good. It's similar to what we are feeling right now. Now, look what happened just prior to that. Look at that big move to the upside, right? That is basically the March, April, and May of last year before this period. And it was just basically up and up and up and up and up. Okay. So the profits come in pretty aggressively again when they come in, and they go away aggressively when they lose. And so that's why you have to stop out and get out of the bad trade quickly. Look at the period of time right after this period. So this is to August 23rd of last year. Look at this September, the October, the November period. Pretty awesome, right? Okay, that's pretty typical for the COT report, right? Let's see, that's that. This is okay. Anyway, just some stuff I wanted to show you guys. Okay, so anyway, I hope that makes more sense about the COT report. We're going to do live trading tomorrow. I'm going to see, I might actually post a couple of trades here soon because there looks like there's some setups lining up on that NZD yen and that NZD franc potentially. So I might be posting some trades here. We'll see. Yeah, so maybe keep an eye out for that because I might be posting some extra trades here soon. All right, guys. Well, I really appreciate your attendance today. Thank you for coming. Have a fantastic rest of your evening, and we'll see you guys in the webinar tomorrow.